Top Picks is brought to you by Questrade, where you can trade stocks from 1 cent and buy ETFs for free.
And here we go with those top picks with David Burrows. First one up, Royal Caribbean Cruises. I'm going to guess a couple things here that you're looking at, cheaper fuel costs and improving consumer.
Right. So we look for fundamentally sound companies that are good getting better in sectors that are in favor with positive technical attributes, right? Technically attractive, fundamentally sound. First of all, the consumer sector is our favorite sector. When we look at who benefits in a slowly improving consumer economy, one of the first places people spend money is in leisure and travel. We know there's a secular tailwind behind the cruise companies because the 55-plus crowd is growing. RCL is the second largest cruise operator in the world. They've got something like 100,000 berths. As fuel prices go down, their costs, about 12% of their costs are fuel, are mitigated. Pricing has been quite good in the cruise lines. As we go along here, the company is generating billions of dollars of free cash flow, a couple $billion this year. That's a 10% return on the capital. It's a sector that continues to behave extremely well. You could look at Carnival, you could look at Norwegian. All three are behaving well, and seasonally, great time to be looking at it because they're just headed into the peak cruising seasons.
Those berths you talk about, do they lease those or own them, or how does that work?
They own the boats. They got 41 big boats. Interestingly, they do get a little over 10% of the revenue coming out of China, and that is growing very rapidly because while China as an economy is slow, the consumer economy is improving, and the Chinese consumer is finding a thirst for travel.
Next up here is Amazon.com.
Yeah, so we really love secular growth. We really like retail. We really like the consumer. When you look at all of those things, the best spot to be in is online retail. So Amazon has about 11% market share of all U.S. online sales. In the most recent quarter, their revenue for their retail business was up 30% after being up 26% the quarter before that. It should continue to accelerate. Their margins are widening because of the money they've spent on their distribution centers. Their shipping revenues are expanding and margins are expanding. And then the last piece, their cloud-based services business in the most recent quarter had a 60% growth rate. So this is a strong company in a strong group with accelerating metrics. It's not an inexpensive stock, but considering the sell-off we've had in this market and the way the stock's behaved, technically it's very sound. So it basically checks all of our boxes, and it's a core holding.
And we're also looking at another materials company. You mentioned Vulcan, but you like Martin Marietta a little bit better.
Right. So to go the other way, find sectors that have become universally hated and find companies that are behaving very differently than the rest. And in basic materials, one of the interesting spaces is aggregates. Aggregates and cement is a very domestic, local business. So Martin Marietta is number one in 85% of their markets in the U.S., so they have pricing power. They raise their prices every year. If you have a slowly improving U.S. economy, you get volume slowly growing and pricing power, and there's no competition coming from offshore because you don't ship aggregates, over the ocean. So if you think that infrastructure spending will continue to grow and commercial construction will slowly improve, this is a very stable business to invest in. It generates boatloads of cash.
And just lastly here, David, maybe you can come full circle to the top of the show and hold investors' hands here through this period. What's the strategy?
So when we give our presentation on process, I point to this indicator that we look at which tracks the percentage of stocks behaving well. And I highlight that every time you get below 30% and things start to improve, people are scared to death and there's 50 reasons why not to buy stocks, but every time over 60 years it was very close to market lows. So here's where we are today, and it feels bad, and there's lots of negative news, but there's a lot that's in the market already. And so we would say, as you get through September and into October, we're likely to see near-term lows in this market. Look for the names that have held up the best through the decline, and there will be the opportunities.
Always great to see you, David.
Thanks for having me.
David Burrows from Barometer Capital. Our thanks to him. Thanks to you for all your questions. Join us at 6 Eastern for Market Call tonight. We'll have James Telfser on the program. Right now, you want to stay tuned because Catherine Murray is getting all ready to bring you Business Day. We'll see you later on in the day. Take care for now.